This is our Thompson Wright webinar, all about tax in 2022. And I'm hoping with our team of experts that we have with us this afternoon that all of your questions will be answered and we live up to our title of what you need to know. The webinar is scheduled to last for approximately 45 minutes, which does give us time to hopefully answer as many of your questions that may arise as we go through the presentation. To put your questions forward to our expert panel, could you please use the Q&A tool, which is on the Zoom toolbar? That way we can have a look at the questions that are coming through and, as I say, try and answer as many of them live before the end of the webinar today. If we don't get to everybody, I apologise, but we will capture these questions and can come back to you on an individual basis after the webinar. So one final piece of housekeeping, we are recording this webinar, so an on-demand version will be available on the website tomorrow, and if you do need to recap on any of the points made, then please feel free to access that streamed version at that point. So I'd now like to hand over to Sarah Bone to lead the proceedings today, and I look forward to hearing what you've got to say. Over to you.
Thanks, Jo. So welcome to the webinar. So I'm here today with, so I'm Sarah, the Tax Director. I'm sure loads of you already know me. I'm here with Catherine Hancock-Catt, who's our Associate Tax Director, Dan Oakes, one of our Senior Tax Managers, and Richard Heaton, who's one of our tax seniors who joined us last year from HMRC. Topics we're going to cover today then, just a few of the things we're going to try and whistle through in this afternoon session are some of the changes that are coming up in the next 12 months. So we've got the increase to corporation tax for some companies, we've got the increase to dividend rates, increase in national insurance, I'm doing all the doom and gloom, and then there's the super deduction for capital allowances, the freeze on personal allowances tax reliefs. We're going to cover off some of the expansion of making tax digital and the changes to the basis periods for unincorporated businesses. So without further ado, I'll hand over to Dan to talk about business tax.
Good afternoon, everybody. I thought a good place to start would be corporation tax. Let's get the bad news out of the way first, and then we can hopefully talk about things that we can do to help save you a bit of tax with regards to this. So obviously, one of the key things is that in April 2023, the rate of corporation tax is increasing. So if you make profits of more than £250,000, the corporation tax rate will be 25%. Profits between 0 and 50 grand will still be taxed at 19%. But that means that there's a band between 50,000 and 250,000, which will be subject to a marginal rate of tax. Now, that effective rate of tax is 26.5%. So as I say, you'll have 0 to 50 at 19, and then 50 to 250 at 26.5. If your profits are over 250, you'll get the 50 at 19, and then everything else will effectively be at 25. So that's just something to be aware of. We've got this increase in corporation tax that's coming. Now, one of the things that you can think about doing to try and mitigate that, particularly if you are a small salaried director, which many of our clients are, then you might want to look at making a one-off employer pension contribution to utilise your annual allowance for pension contributions. That will effectively be an additional expense on the profit and loss account and will reduce your taxable profits. So you're extracting some money out, you're increasing your personal wealth for a later date, you're also saving some corporation tax. But another really useful thing to bear in mind and to be thinking about, particularly now and also over the coming year, is capital allowances. So in the budget, the Chancellor announced that the annual investment allowance in when you're invested in plant and machinery and equipment of £1 million is remaining now until March 2023. It was due to drop down to 200,000 at the start of this year, but they're keeping that in place now until March 23. So that's good, because what that means is if you spend a significant amount on plant and machinery and kit, you can get 100% write-off in the year of purchase, rather than it dripping out under writing down allowances. Now, something else that was announced in the latest budget was the super deduction. So the super deduction is as well as and also in addition to the annual investment allowance. And what happens here is if you spend, again, money on new plant or kit, you can get an extra 30% uplift of tax relief. So effectively what that means is if you spend 10 grand on a new piece of plant, you would save under annual investment allowance, that 10,000 would come off your taxable profits and you'd save tax at that rate. But with this, that deduction gets increased by another 30%. So again, in that example, if you spend 10 grand, your tax relief would be 13,000, obviously applicable at whatever the appropriate rate is. So that's a really beneficial new relief that's come in and giving that enhancement. Again, the idea is trying to promote investment in equipment and in industry as we try to recover from COVID. Just a point to note though, if you buy equipment and kit that will perhaps have a substantial value at the end of the time that you're going to use it, perhaps like a van or some plant or something like that, that you perhaps would sell within, say, 3 or 4 years. If you sell it in 3 or 4 years' time, whatever you get, that will also get uplifted by that extra 30%. And also, it could be subject to that higher rate of capital corporation tax that's coming in from April 2023. So just bear that in mind. We can advise you and help you with that, but just bear that in mind in how you use it. Of course, another area where capital allowances and other reliefs can be lucrative is in property. So if you've got a commercial building, when you build it or when you perhaps carry out a renovation or an enhancement or something like that, within the building, there is going to be a mixture of structural items, but also things called fixtures and fittings that also qualify for capital allowances. So the items that qualify for capital allowance, you think like lighting, heating, electricity, all those things, you want to try and maximize as much of that as possible that we can identify and claim capital allowances on. But for everything else, the bricks, the mortar, the roof, the ceiling, all those kind of things, well, we've got this structural buildings allowance. So anything that doesn't qualify for capital allowances can qualify for the structural buildings allowance, which gives you basically the value of that spend. You get a 3% write-off every year against your taxable profits up to 30 years. So again, another beneficial relief there on something that we didn't used to be able to claim anything on. Just bear in mind though, with capital allowances claims, the devil's in the detail. So perhaps if you are thinking about a construction or a significant renovation or even buying a property, please speak to us because we can put you in touch with people that can help you to make sure that you get all the records that you need to maximize any potential claim. Another really useful tool for tax relief, company tax relief, is research and development tax credits. So again, coming off of Brexit, coming off of COVID, the government are keen to promote investment and innovation, and so they offer these generous tax reliefs for qualifying research and development. So as the slide says there, for small and medium companies, what this does is if you spend on qualifying R&D, when we're doing your corporation tax computation, you'll get an additional amount of relief against your taxable profits. So for small to medium companies, that's an additional 130%. What that means is for every 10 grand you spend on qualifying R&D, you'd get another 13 grand taken off your taxable profits. That's on top of course, the 10 grand that's already sat in there anyway.
So Dan, just thinking about this, are there some good tips we can give on good examples of the things that people might be spending on that they might not realise would increase their R&D?
Yeah, so there's a range of costs that qualify. Typically, the most common cost that qualifies for R&D is employment costs, basically deploying your staff into carrying out the research and development. So you'd apportion their time and you'd establish their costs. So that would include their salaries, employer pension contributions, and their employer national insurance. But quite often we find that perhaps the directors of our clients are the ones that carry out a lot of the R&D. Now, if they're on a small salary, only the salary element would qualify.
So the dividends don't count, do they?
The dividends wouldn't count. So therefore, again, we come back to that point that we mentioned earlier about making one-off employer pension contributions, because that is a qualifying cost. Likewise too, if the director or indeed any staff carrying out mileage claims or travel expenses with regards to R&D, all of those things can go in. There's a lot of detail about what costs qualify and what don't. We haven't got time to go into all of that, but it is something that we can help you with understanding, making sure that you maximize that. Now, of course, with this additional relief, it may be that this additional deduction from your taxable profits might result in a loss, a taxable loss. Now, that loss can be used to be either carried back to a more profitable period or carried forward if you know it's going to be a profitable period in the next period. But if you can't use them either side, perhaps because you've got ongoing R&D claims, you can exchange it for an immediate 14.5% tax credit. That's basically an immediate cash in hand credit from the government for those losses that you've surrendered. Now, the next point is quite key here. What work qualifies as R&D? You'll often get a lot of people telling you, oh, you're doing R&D, you should be making a claim. But in order to qualify as R&D, there has to be a project that is looking to make a significant scientific or technological advancement.
I think a good example there is if somebody else in your industry already knows how to do it, you're not doing R&D. If you're just trying to work out what they already do, that's not R&D, is it?
To within reason, yeah. I mean, obviously there might be secret patents and things like that, but generally, if it's an accepted method or process within your industry, that information is readily available to you, then it's not really going to be R&D. What we're looking for is going above and beyond. There's uncertainties that you as a competent professional don't know how to resolve, and that's why you're carrying out this research.
Almost failing a couple of times proves you're doing R&D.
Exactly, yeah, testing, all of that kind of stuff, prototypes, all of that kind of thing. So that's really, really key. The government are quite hot on making sure that the project you're carrying out does meet that criteria. Now, another thing that we've mentioned here is perhaps doesn't apply to a lot of our clients that make R&D claims, but it can do, is the RDEC scheme. So for large companies, they don't get this very generous relief. They get this RDEC scheme. It's still beneficial, but it's not quite as good. But small and medium companies can get caught by this if any of the R&D that they are carrying out is subsidized in some way. So that could be that they could get grant funded to carry out the research work. If that was the case, that project would fall into this RDEC scheme, the less beneficial scheme. But equally, if perhaps you've been engaged by a customer who's going to pay you for your R&D time, then again, that would be subsidized. And that's something that the revenue are picking up on quite a lot. We've got a client that's going through, we haven't helped them with the R&D, but they've been picked up by HMRC, and that's something that they're really zoning in on.
It's such a generous relief that HMRC are going to have an extra look at whatever you claim, aren't they?
Yeah, and that's in line with the warning that we put on the screen there, that there are a number of, or there were rather, a number of rogue companies out there telling everybody that you can do R&D. I won't give any specific examples, but we have heard some spurious ones.
Yeah, we've had some
before,
good stories.
That you'd never think that was R&D in a million years. So you've got to be really careful about who you choose to help you with doing these R&D claims.
And I think the danger as well is sometimes those companies might not be still around by the time the revenue comes to knock on the door. That's the problem, isn't it?
Yeah, of course. So one of the things that was also announced in the budget recently was that HMRC are getting more resources to carry out investigations to look into R&D claims, because it is such a generous relief and it has unfortunately been abused. So again, if you've got specific questions about R&D and making claims, please speak to us. We can put you in touch with reputable R&D specialists that have got an excellent track record with HMRC and have been successful in making claims. They can assist you in record keeping, identifying what kind of things qualify and what kind of things wouldn't qualify, and making sure that your claim is strong and robust. So then moving on to perhaps some more kind of day-to-day things that can also be of benefit in business tax planning is various other smaller things. So particularly with regards to perhaps your employees, a few years ago now, there was introduced a trivial benefit scheme. So this means that you can provide employees with gifts or vouchers up to the value of £50. It can't be cash, but it can have a value of up to £50 for special occasions, birthdays, Christmas, weddings, bar mitzvahs, you name it, christenings. I'm sure you can think of various different things, but each gift has to have a value of £50. We quite often see people giving like shopping gift vouchers and things like that.
One for all is a good one, because it can't be exchanged for cash, but it can be used in a number of places, isn't it?
That's it. But the key important thing is that it can't be a reward for service or performance. That's quite a key thing.
And there's also a limit for directors as well.
Yeah, so there's whilst per gift it's £50 per time, there isn't an annual limit for employees, but for directors, the annual limit is £300 each. So just bear that in mind. Another really useful benefit that you can provide is things that qualify for salary sacrifice schemes. So again, you can provide your employees with benefits. They can give up part of their salary, things like electric company cars, employer pension contributions, cycle to work schemes. These are all really useful because these kind of salary sacrifice schemes can mitigate and save national insurance for both the employee and of course you as the employer as well.
So as you said on your tip there, that's with the NI rates going up, it's quite a pertinent one to be thinking about, isn't it?
Yeah, and I think Kat will give you a bit more information about that further on. So that's something that's quite useful. Again, an obvious one, but sometimes missed, making sure that you've made all kind of eligible expenses. You've claimed all of those and put those through in your accounts, particularly for employees, making sure that you've paid them their mileage claims and travel costs and all those kind of things. Obviously, the key thing to remember though with corporation tax and business tax, expense claims, the expense must be wholly and exclusively related to the nature of the trade. So we can't just put any old expense through and think we'll get tax relief for it. But if you can relate it to the trade, then you can. Another useful tool, perhaps with regards to retaining key staff and incentivizing them, is perhaps allowing them to get a bit of skin in the game into helping you operate and run the company. You might want to give them shares. Well, a good way of doing that is using an EMI share scheme. So this is an approved share scheme by HMRC. It's a very tax efficient way of allowing them to get shares in the company. Obviously, if they've got shares in the company, that'll help to retain those key staff and of course incentivize them to boost the profits. And then of course you've got things like flat rate schemes, flat rate expenses. A big one recently through COVID has been use of home.
Yeah.
About £312 a year that can be claimed by employees. Again, if you as an employee decide to pay that to an employee, it's tax-free on them, but it's also a tax-deductible expense for you as well. And then thinking about unincorporated businesses, again, there are similar reliefs there as well with flat rate expenses, mileage claims, things like that, use of home. Also, not to be missed is the trading allowance. So perhaps if personally you've got a little bit of side income, a bit of hobby income, as it were, if that was less than £1,000 in the tax year, you don't need to declare it. If it was more than £1,000, but you've perhaps not got very much expenses, you can offset that £1,000 trading allowance in full against that income. So again, that's quite a beneficial relief. Something else we've mentioned here, and this will be talked about a bit more with regards to making tax digital, but changing your basis period. So basically, if you're an unincorporated business and your year end was not in line with the tax year, i.e. the 5th of April, let's say it was the 30th of April or 31st of December, for example, your tax basis period isn't in line with the tax year. And potentially, when you first started up, you may have paid tax twice on the same profits. And now that is a latent relief that's sat there. Potentially, by changing your year end, you could release that relief and gain some tax relief, some extra tax relief, and reduce your taxable profits. Now, this is going to be something that's going to affect all unincorporated businesses that haven't got a year end that's aligned with the tax year in the year 23-24. So it might be something that we want to perhaps look at sooner rather than later so that we can plan out when the best time to make that move is. So I think that kind of covers a lot of things with regards to business tax, and I've talked long enough now. So I'll hand you over to Kat, who'll take you through some personal tax planning.
Thank you for that, Dan. So on to personal tax planning. Currently, everyone has a personal allowance of £12,570 per annum. Then they can earn up to £50,270. That's within their basic rate threshold. So income between £12,570 up to the £50,000, the taxed at basic rate. Anything above that, up to £150,000, is taxed at the higher rate threshold. And then there's an additional rate for those high earners who are earning above £150,000. Also, as Dan mentioned before, national insurance rates are increasing by 1.25% from April 2022. So the rate is going to increase from 12% to 13.25%. And then if you are earning above the upper earnings limit, it will jump from 2% to 3.25%.
On that point as well, employers' national insurance is also going to go up by 1.25%. So that's going to go up from 13.8% to 15.5% at the same time.
Thanks for that, Richard. So looking at how we take our money out of a company, how do we extract our income? You can take your money out via salary, which is obviously one of the highest tax rates at 20, 40 and 45%. You can also take your income out via dividends. Obviously, you have to have profits in the company to be able to do that. But dividends attract tax at 7.5%, 32.5% and 38.1%, which is obviously lower than salary. Also on your salary, you've got Class 1 national insurance to pay. And currently there's no national insurance on dividend income. So obviously that's the more beneficial way of extracting your income. If you own the trading premises, personally, you can charge rent to your limited company and extract some of your income out via rental income. Obviously, we need to be careful with planning on that because that can impact your business asset disposal relief in the future, but we can talk you through that and assist you along the way. If the company owes you money, so you have a credit director's loan account, you can actually charge interest on that loan account and extract some money via interest payments. Everybody has a personal savings allowance. So if you are a basic rate taxpayer, you could receive interest of up to £1,000 tax-free during the year. So that might be beneficial to some. And also, as Dan mentioned before, company pension contributions are another way of extracting income because that won't cost you any income tax now when the pension contributions are paid, but it will increase your wealth for the future. So looking at dividends and taxation, everybody has a dividend tax band of £2,000 per annum, of which no income tax is payable. So firstly, have you utilised your 0% rate? Dividend rates are then going to be increasing from April 2022, as well as national insurance, unfortunately. But the basic rate will increase to 8.75%. Higher rate will increase to 33.75%, and the additional rate will increase to 39.35%. So that's just something to bear in mind that if you are taking money out of the company via a small salary, let's say in dividend income, the tax rates are going to increase next year. So have you utilised your basic rate band up to the 50,270? Like many of our clients, they'll extract their income via a small salary and dividends. And on this, you'd pay a personal tax cost of £2,678. So that allows you to extract out of the company £47,593 of net income. And then looking at higher earners, again, if your income is between £50,000 to £100,000, it might be worth taking your income up to £100,000 in this current tax year if you're looking at taking out more the following year. Because what we can do is utilise your higher rate tax band instead of in the following year your income going above the £100,000 threshold. Obviously, if you do exceed the £100,000 threshold, you start to lose your personal allowance. And the rate of your income tax on anything above £100,000 is 60%. So that's the rate of tax we don't want to be in. So looking at some more personal tax planning here, could you exchange your salary for benefits? So if your income is slightly above the basic rate or higher rate threshold, could you do some planning now in February and March to possibly exchange some of your salary to maybe an approved share scheme or additional pension contributions to bring your income back down below that threshold? Obviously, if you go above the £100,000, we're paying a lot of tax. So if we can keep it below, that'll be a nice tax saving. Exchanging your salary can also minimise the impact of the NIC increase because it's a salary sacrifice. You save tax and national insurance on those contributions. Looking at one that sometimes gets missed, gift aid contributions. So if you're making gift aid contributions during the year, you're actually able to claim higher rate tax relief on your tax returns. So if you're a high rate taxpayer, we can include that on your tax return and you'll save an extra 20% there.
On that, if you're not a taxpayer that falls under self-assessment, if you just give the revenue a call, they can make sure that the gift aid contributions that you've paid are included in your tax code, so you can get relief that way.
So that's worth knowing. People don't miss out then. And also generous relief on gift aid is if you make a gift aid contribution in this current tax year, you can actually carry the relief back to the prior tax year. So if at all you go over in one tax year, you can still plan for the year before. Personal pension contributions. Have you maximised your available annual allowance for the tax year and any unused allowances from the prior 3 tax years? Everybody's got an annual allowance of £40,000 per annum. Obviously, high earners are subject to tapering, which Sarah will come on to later on. But you can utilise the prior 3 years as well. So potentially that's a nice lump sum that you could put into your pension and claim high rate tax relief on that as well. So looking at some more personal tax planning here, dividends and bonus payments. If you're looking at taking an extra dividend or maybe a bonus out of the company, have you considered paying these early so they fall into the current tax year, or possibly deferring them to fall into the next tax year so you don't exceed your threshold? Directors' loan accounts, again, if you have a credit director's loan account, could you extract interest on that tax-free? Also, we've got a marriage transfer allowance here. Not many people have heard of this, but if you are earning less than your personal allowance, you can transfer 10% of it to your spouse or civil partner, and it can save you up to £250 in tax, which is obviously quite a good little saving there year on year. There are conditions for this, so the higher earning spouse or civil partner cannot exceed the basic rate band on their earnings. Something to bear in mind. Moving on to capital gains tax planning. So everyone has an annual exemption for capital gains tax of £12,300 for 21-22. This is also now frozen till 2026 as part of the wider freeze on personal allowances that the Chancellor announced in the budget. However, what we can do is transfer between spouses, which are free of capital gains tax. And what that means is you might be able to maximise those annual exemptions by utilising one each. Business asset disposal relief, as everybody used to know it, entrepreneurs relief, is also available if you're selling a qualifying business asset. However, the lifetime limit has been reduced from 10 million down to 1 million. The CGT rate is taxed at 10% if you're eligible. So obviously that is a good relief. Looking at anybody that's got any properties, so property tax planning, everybody's got a property allowance of £1,000 per year. So if the expenses in your rental business are less than £1,000, like the self-employment allowance, you can claim the flat rate of £1,000 against your rental profits. Worth noting that this allowance is per property, not per person. So if you jointly own a property, then you can claim that per person. Also, there's an election that you can make. So if one spouse is a high rate taxpayer and the other is a basic rate taxpayer, you could consider passing on more of the income to the lower rate taxpayer. Careful planning needs to be considered here, so get in touch and we can help you with that. We have a sister company, Thompson Wright Financial Planning, who can provide financial advice to you. I've listed some tax efficient investments there if you're looking at doing anything like that. VCTs and EIS investments come with income tax relief, and so do SEIS investments. So if you're considering looking at some investments, please get in touch with them today. I put a slide on the screen there to show you the contact details. The directors of the company are Stuart Maddox and Chris Devey, and their email addresses are on screen. Now I'll hand over to Sarah Bowen, who's going to talk to you about inheritance tax.
Thanks, Kat. So as well as all the sort of in-year and the things that are changing, we thought it would be useful to just have a little run through inheritance tax, as it is a tax that's affecting more and more estates as people are getting wealthier and as house prices are going up. So we've just got a slide with the rates on. So these rates should be familiar to everybody. So we all have a nil rate band of 325,000. We have a residence nil rate band if we've got a main home of 175,000. If husband passes away and leaves all his estate to his wife, then those nil rate bands and residence nil rate bands are transferable. And so then when the wife passes away, she would get the benefit of that. The idea of that is that combined for a couple, you will have a nil rate band of £1 million of wealth that you can leave to the next generation before you pay any inheritance tax. Every year, we can also make gifts of £3,000 without an IHT consequence, small gifts of £250. And if somebody in your family is getting married, then the gifts of between 1,000 and 5,000 can be made. The difference is depending on how closely related to the individual you are. So parents can make a bigger gift than, say, grandparents. Some other things that don't attract an in-life IHT charge are transfers between spouses. So if you gift something to your spouse, that won't cause an IHT problem. Everything else, or most other gifts, are what we call a pet, which means that no inheritance tax will be charged on them, providing that you live for 7 years from that gift. And most people have heard of the 7-year rule for inheritance tax. One thing that can be quite interesting is the use of charitable donations in your estate. As it says on the slide, an estate which gives more than 10% or more to charity actually reduces the headline rate of inheritance tax from 40 to 36%. And actually, this can be quite clever, because if you were giving sort of 6% of your estate away originally, it can actually mean that more money goes to your beneficiaries if you actually increase that to 10 and reduce that headline rate of inheritance tax. That's actually sort of a bit of a clever trick to do that. Some other exemptions, and if anybody's ever been to have an IHT planning meeting with me, you will hear me waffle on about gifts out of income all the time. So what we need to think about is, as we get older, we tend to find we don't spend as much of our money, our wealth tends to grow. And if your wealth grows, and if you're over that £1 million as a couple, potentially that's more wealth that's going to be charged at 40% to inheritance tax. However, if you can gift income, that can be different.
Yeah, I was going to say, what's the difference there between capital and income? How are you defining that? So
what I usually ask people to do is, if you want to start to make gifts out of income, the best thing to do is sort of make a list of all your income. If you could do a tax return, that's pretty easy. Work out your normal expenditure, your council tax, all those good things. If you've got money left over, that's income in that year. And for the year after, that's income. After 2 years, it becomes capital, and then giving it away would be subject to the PET rules and things like that.
Right.
We've obviously talked before about pensions, and we've got a bit more coming up later about pensions, but pensions fall outside your estate for inheritance tax. So I try and think about wealth in pots, and almost, especially with pension freedom now, freedom drawdown, your pension pot might be one of the last pots you actually touch, because if you've got your pension set up to pass to your family, that's free of inheritance tax. And a final thing to talk about is trusts. Trusts can be a really effective way of planning and saving inheritance tax, and setting up trusts in a lifetime can be beneficial. But trusts can pay a lot of tax, income tax. So there's something you need to have a conversation with one of us about.
Yeah.
A lot of people on the presentation today, I guess, are our clients and our business owners. So one thing to remind everybody is that your shares in your business, if your business is a trading business, and Dan and I've got clients who fall somewhere in between those two definitions, but if you fall into the definition of a trading company, then your shares in your business, your value of that business will be free of inheritance tax. And there are other investments that you can do that can mirror that relief. So for example, if you invest in an AIM listed company and hold those shares for 2 years, or hold those shares in your ISA for 2 years, they become free of inheritance tax because they benefit from business property relief. Kat mentioned using EIS as a way to save income tax, and after 2 years shares in EIS companies are free of inheritance tax as well.
It's important to note that doesn't cover VCTs though, does it?
No, not VCTs, only EISs. And then finally, agricultural property relief, which is the sister relief of business property relief. This is in place to cover the agricultural value of farms and farmland. Very, very important to note, though, it only covers the agricultural value. It doesn't cover any sort of hope value if you think you can get planning permission.
Yeah.
We talked about pensions quite a bit. You can probably tell we're quite fond of pensions, but pensions do have lots of benefits and are a great way of saving tax. So some things to just think about. The lifetime allowance, the maximum you can hold in your pension before there are further tax charges when you draw it down, has reduced over the years. Currently, it sits at just over £1 million. If you're getting close to that allowance, you might want to fix that protection. You can make an election through your IFA to protect that so that if it falls again, you aren't affected by that. Annual pensions allowances, I think Kat covered this. So most of us can pay £40,000 into our pension each year tax-free. And if we didn't use that allowance last year, then we can go back and use that. If you are a high earner, you do just need to be careful because actually that allowance tapers all the way down to 4,000. So again, that would be something you'd need to talk to either us or your IFA about. Some other little bits on pensions then. There are such things as stakeholder pensions. So pension rules and what income you can put into a pension, the rules are actually a little bit complicated, but everybody can put £3,600 into a pension, even if they're a child. So sometimes I have clients who start pensions for their grandchildren. It's just a great way of starting some savings for them that they can't blow until they're in the 50s. Can't buy a Ferrari with it till they're in the 50s, but anyone can have a small pension like that. Pensions are very, very flexible now, so we do have sort of freedom of drawdown. So once you're 55, although that is going up to 57, we won't be able to get ours at 55, Dan, I'm afraid. Then you can draw down on your pension. You can take a 25% lump sum, and then with pension freedom, you can choose how much you take out of the fund, and you can perhaps match that to other income, your dividends and salaries for people who are still working.
And that's really useful for planning, because you might have a year where you have a dip in income. So if you can access your pension, you might do it that year, but then something else might come along where you don't want to. So you've got that flexibility. It's really good like that.
And now I'm going to pass back to Richard and Kat to talk about making tax digital.
Sarah, thank you. We wanted to talk about this. It's something that's coming on the horizon for everybody, making tax digital, and it's going to be a real change in the way we interact with HMRC. What's going to happen is HMRC are going to digitise the entirety of the tax system, replacing all manual administration as is current with an online digital system for reporting and paying tax. This is going to go further than the current online return filing. Will mean that businesses are going to need to keep records digitally using revenue-approved software. They're going to need to submit quarterly reports to HMRC, and they're going to need to submit an end of period statement at the year end to HMRC. And on top of this, we're still going to need to be sending in the usual tax returns and everything else for the foreseeable future. On top of that, the tax point, by the way, won't change. That's going to, the point at which you pay tax is still going to be when you send in your tax return, as it is now.
Yeah, so just to be clear on that, obviously we prepare your annual accounts and self-assessment tax returns if you require one. That's not going to change. We're still going to have to do that. But as well as that, we're going to have to submit quarterly returns to HMRC and an end of period statement. That's all on top of the normal filing, unfortunately. However, the tax point when your tax payments are due, that won't be changing at the moment.
Okay, so any of you who have a VAT registered business above the VAT threshold will already know that they've had to comply with MTD since April 19 for VAT purposes. You'll probably also know that a lot of people, a lot of businesses underestimated how much they needed to do to prepare for MTD.
Especially for those manual businesses, It was a big changeover to move on to an electronic system, but a lot of clients are already on those platforms, hopefully.
Hopefully. Those businesses that were involved in that had what HMRC called a soft landing when MTD started for VAT. which meant they were given a bit of leeway on how much software they used, how they used it. There was foregone penalties for failures, that sort of stuff. Unfortunately, the soft landing ended in 2020 and new businesses involved in MTD aren't going to get it, nor is anybody who is involved in MTD for any of the other heads of tax when they come on board. So it's going to be absolutely vital that you're ready for MTD when it comes in and that you've got the software and compliance facilities in place to ensure that you comply with what HMRC want.
Which we can help you with along the way.
Yeah. Okay, so from April this year, MTD for VAT is going to be extended to all VAT registered organisations. That means smaller VAT registered businesses with a turnover below the VAT threshold are going to need to register for MTD. And they're going to need to do that in the foreseeable future. They're going to have to make sure they're fully compliant with MTD and they're using the same HMRC approved software to record and report their VAT information quarterly.
And then on all unincorporated businesses in existence already at the 5th of April 2023 that are turning over £10,000 or more, and this can be from a self-employment trade or from land and property income, they must be MTD compliant for the tax year 6th of April 2024. So that's the 24-25 tax year. Any new unincorporated businesses starting from the 6th of April 2023 will have a phased-in period, and HMRC will notify them of their first date that they're required to file under MTD. And we've got normal partnerships. They will come online for MTD in April 2025. Complex partnerships have another year, so they're going to start in April 2026. And then for all big corporate companies, they're not expected to begin before April 2027.
As I said before, it's absolutely vital that businesses are ready for MTD, and this means that you're going to have the software in place and know how to use it in order to comply with what HMRC want from you. Your software has got to be able to maintain and preserve your records digitally. You've got to be able to create returns from digital records that you've maintained over the year and provide those returns to HMRC quarterly and annually in a digital format. You're going to need to be able to provide HMRC with tax data voluntarily so that if they come to you asking for information, you're going to be able to provide it in a digital format across the platform. And you're also going to have to be able to receive information from HMRC through your software. All of this has to be maintained to submit the quarterly reports and to produce an annual return, and this on top of what is already being required in terms of tax returns, VAT returns, and all the other returns that are required from you by HMRC.
Just want to add more filing deadlines to the workload, unfortunately. So just looking at some of the softwares available, this is only a small list. There are other softwares out there. Xero, a lot of people might have heard of Xero already or be using it themselves. Sage, QuickBooks, and also Cashflow. Our staff are able to provide training sessions on how to use all of these softwares, and we're also proud that we are Xero Gold partners. So obviously we can help you implement that into your business and help you set up for making tax digital. Over on this page, if you can see on the screen, there's a roadmap here from when MTD started, and it goes all the way through to 2027 on the final phasing in period. This roadmap's available on our website, so don't worry about trying to make notes on this now. You can view that on the website, as well as we've got a document on there which just gives you some more information on making tax digital. So thank you for listening today. Obviously, we welcome any questions from you. Don't know if there's any in the chat box.
I don't think there are any questions. So just as a reminder, folks, this has been recorded and will be available as a download tomorrow. Thanks very much for everyone attending this. And if you have got questions that you haven't put in the chat box, obviously you've got our email addresses, so just pop one of us an email.
I've left the contact details on the screen there, so that's to cover all of our offices if you want to get in touch.